Hi, I'm Button from freefincal, and these are 15 of the most common investor mistakes that I have observed. Um, I have been talking about personal finance on stage for the last 5 years. I just realized it, and I thought I'll compile a list of some of the most common mistakes uh, that I notice. Of course, I'm not a big fan of behavioral finance per se because I tend to have a view that who am I to talk about other people's money management? Who am I to say X or Y trait is a mistake? But I also believe that those who talk about behavioral finance also have behavioral traits which have to be criticized about. But still, some I mean, there are some attitudes, some notions, some beliefs, which, in my opinion, that are not productive, and it is in that sense I think of them as a mistake. You can argue that it's what I think is wrong, of course, but in some of these instances, I have shown with data that the beliefs are wrong, and I will try to include the proof in the what they call the I button, yeah. So wherever I can. So let's get started. So the first, I mean, I'm not average them. I mean, I'm not numbers are not average. I'm not linked them in any order. I've just thought about it and just put in the slides. So the first idea that many investors have, they have a wrong idea of averaging. That is, they buy more of the same thing and assume it's better. They buy three large cap funds, three multi cap funds, and they'll buy Nifty 50, then one multi cap, then one aggressive balance. So they're essentially buying more of the same thing, and they think it's averaging and it'll reduce risk or protect them from downsides. It will not. If you buy more of the same thing, it will never help you in risk or return. You have to, by averaging or diversification, you should buy uh, apples, oranges, and tomatoes. If you keep buying more and more of oranges or different types of oranges, you will just end up getting, pretty much similar results to having just one of them. So that's one common mistake I see. They, in the name of diversification and asset allocation, they just buy more of the same thing, and that's completely wrong. Uh, Waiting for a suitable time to invest, this waiting for a suitable time to invest is okay, but the problem is that many people don't have a method. They just ask people, can I invest now? Should I wait for the market to cool down? The market is at an all-time high. I just talked about it 2-3 days ago. Should I wait until the elections are over? Why should you wait? What logic is that? The day after you invest, if the market crashes, what will you do? There's absolutely no logic in this. There are people who have methods. They will have trends. They will look at the Nifty PE, wait for it to reach a certain level before they put in money or remove money. They will have indicators like 200-day moving averages or whatever, double moving averages, whatever it is. I have a valuation tool. You can have a look at it. So people who have a method and will not ask, and they know when to do it. But of course, you should, people, if you also like those techniques, you should stick to one of those methods, otherwise it will be a problem. So don't just wait for a suitable time to invest. Either you have a method to manage risk, or you keep or you just keep investing systematically and do systematic risk management. Don't wait for a suitable time to invest. I have showed you. Also, I've shown in another video that investing on dips alone will not help you in any way. So this has no. Uh, this has no use. That's my point. In that sense, it's a mistake. Expecting a return from market-linked instrument. This is a bit dramatic statement to make, but this is unfortunately this is true. I mean, you can't say I'm expecting 15% return from Sensex for next 20 years, or 15% return from Indian stock markets overall, and so on, or from this mutual fund or from that mutual. That doesn't work, because the range of returns, the possible spread in returns over 10 years, 15 years, 20 years in the stock market is very, very huge. The only reason why you do not see such a range in the Indian stock market is because of less data. I have just purchased some S&P 500 data yesterday, and I from 1927 onwards, and I have the rolling returns data. And I'll show you 30 years data will still fluctuate a lot, and it will not beat inflation and so on. So don't make such assumptions. It's wrong, and expect 10%, 20%. You will not get it. The what is the alternative? Well, the alternative is to not focus on returns, is to focus on your corpus. What is the corpus I need for my goal? And keep an eye on that. And I've been telling this again and again. In addition to rebalancing every year and so on, or whether you want to do tactical in addition to it, whatever it is, keep an eye on that corpus, because that is your goal. Your goal. You cannot eat with returns. You need money to eat, or you need money to send your kids to college. You cannot send your kids to college with returns, right? So uh, keep an eye on that. Gradually push money to safer assets, and don't worry about anything else. Don't worry about returns. Push it to safer assets. Then you will be. Then you can face any crisis. I told you in my audits that what I have done is that I now have enough money. My kid is only 9 years old, but I have enough money to send him to a UG degree now. So I can handle a market crash today. I will still not. My goal will not be affected. Of course, I will be emotionally affected. All that will happen, but my goal will not be affected. So that is the way to manage this, and that is what you should do. Do not expect returns from investments. Market linked. You can expect a return from FD. That is fine. No problem. Overconfidence based on past data. People say stock market, Indian stock market has always given 15%, always given 10%. This in of itself, this is wrong. If you actually look at rolling returns, this is not true. And I have seen people in Asan Ideas of Wealth Facebook group say last 3 years liquid funds have given 9% returns. That's just that's because of a certain event that occurred that gave you that. That doesn't mean when you start investing, you will get 9% returns in liquid funds. Have you got 9% returns in the last 3 years in liquid funds? No. The same people who claim that have not got it. This is stupidity. Just look at last few years data and say recency bias, right? That's completely wrong. Don't do that. Oh my God, this is so annoying. Feeling the need to know about every new product. My inbox is filled with mails. Have you looked into this NFO? Have you seen this NFO? What for? Okay, I benefit from reviewing every NFO because people will read it, people will view it. I will get money out of it. That's the only use. What is the use for you? Most of the people who are interested in NFOs will probably not invest in it, or they will invest small amount in it for no. What use is it for? Don't waste your time learning about every new product in town. Small case, alpha SIP, beta SIP. The guys who talk about this are basically sales guys. I mean, they may not be literally sales guys. They are part of the company, so they obviously have a conflict of interest, and they will paint you a rosy picture. Either you should know you should spend your time and analyze the data. Otherwise, don't bother. You're not going to miss out anything just by not knowing it. You're wasting your time. Go get yourself a new hobby. It's a complete waste of time. Of course, that's what is keeping people like me alive, afloat, the blogging business. I have to write something, this NFO, that NFO, that NFO. Garbage. Suffering from small exposure syndrome. I have a separate video for this. This is like not focusing on the big picture and saying, oh, you get 50,000 tax saving advantage from NPS, so I will put one every year 50,000. The truth is, are you actually investing? You probably need to invest 3 or 4 times more than that for your retirement. Are you actually investing that right? If that is right, then you will not worry about this 50,000 tax saving. Just psychological, trivial benefits, and have you saying, I will have small exposure of international stocks. I will have small exposure. ICICI is coming with a new MNC fund. I will take 5% exposure to it. I will take 5% exposure to Nifty next 50 because everybody is talking about it. This is just stupidity. It will not help you at all. Sorry. It's just unproductive. It will not make any difference in your portfolio. Judging mistake. Whoops. So, not having yardsticks for judging big or small. What is a high return? What is with respect to what? And what is a lump sum with respect to what? I may have, if I have 100 lakhs in the market, if and I receive 5 lakhs, that's not a lump sum for me. I'll just put it in the market. That's it. That's not a lump sum for me. If my salary is 3 lakhs a month and I receive 1 lakh, that's not a lump sum because I probably will be investing. I hope I'm investing 1.5 lakhs a month, 1.5 lakhs every month. I receive 1 more lakh, I just put it away. That's it. So you should have a yardstick for everything before you judge. There's nothing big or small as absolute. Big with respect to what, small with respect to what. That with respect to what is missing in the case of most investors. They don't have a yardstick at all. You should have a yardstick for returns. You should have a yardstick for risk. For example, somebody told me, there was a comment, and I've seen that article too. There's a value research have shown that all mutual fund SIPs 7 years and above have never given negative returns. So if I invest in a mutual fund SIP for 7 years, I invest in it for 17 years, and I find that my return is 2%, I will be happy. I've taken so much risk by investing in an equity SIP. I'm talking about equity SIP, and I get a return of just 1 or 2%. That's not negative. So that does it mean I have not made a loss? Of course, I've made a loss because the real return is zero because inflation is so much higher. So please have the yardstick for judging big, small, good, bad, ugly, whatever it is. So unless you have the yardstick, you cannot make judgments. This is a big one. People assume I have to track my investments. I have to consolidate all my investments. I want a portal where I can consolidate everything. Oh, for God's sakes, leave your money alone. You want to know who is the biggest enemy for your money? For who is stopping you from becoming rich? Go look in the mirror. It's you. Stop looking at your investments. Look at your investments once a year. You don't need an app for all that. You don't even need an Excel sheet. You should, what I would suggest, you create an Excel sheet, let's say every December or every, let's say June, whatever it is, half the year. Look at it, review, delete the Excel sheet, do it again next year. Nothing will happen. Nothing will happen. Your money will be safe, you will be fine. Don't track your investments. Watched kettles don't boil. You just keep worrying about your investments and do something wrong. Don't track. Just don't track. It is completely unproductive. Some people say, I watch every day, but I don't do anything. Why are you watching them? Go get a life, man. Oh. Assuming information is power. I've talked about information diet again and again and again. Stop thinking that you have to know about what that guy has written, what this guy has written, what they are saying about this product, that product. No, information is not power. Information is confusion. Information is indecision. Stay away from all that. Knowledge is power, and knowledge is lack of information. So don't. I've told, I've said this many times in the video as well. I'll say it again. Stop watching my channel. If your money or management is in place, show the URL to or share the videos to your friends who you think need some help. You graduate, move away. There's no point watching. I'm saying the same garbage again and again, right? Have you not noticed? If you have not noticed a pattern in what I am saying, if you think you have learned from my channel, or if you think what I'm churning out every day is useful, then you must notice a pattern in my sayings. If you do not notice a pattern, then something is wrong. Stop watching. If you have noticed a pattern, stop watching. Then also stop watching because you have. I am no longer useful to you. That's the point. Get that pattern. Once you get that pattern, move away. Go on to do something else. Don't think about money. And this is a common mistake. Assuming more risk is more returns. I am young. I will invest in small caps, more of small caps, more of mid caps. I don't want large caps. Large caps, I will move to large caps when I become 30 or 40 years old, or 50 years old, whatever. This is just garbage. This is absolutely wrong. I've shown this is not true. It doesn't work. You must have a diversified portfolio with proper risk management at all times, whatever your age. And most people don't know. And another mistake which is very related to this, I have not actually written it down explicitly, is I have large risk appetite. You don't know anything about your risk appetite unless and until you have suffered a crash. Most people who are investing in the capital markets today have not seen anything, any big losses. And some people say short term equity market will be volatile in the short term only. In the long term, things will be okay. How is it possible? The short term losses or gains concatenate and create the long term loss of the gain. Everything matters. Sequence of returns matter. If you do not understand sequence of return, you will never manage risk. I have a video on that, maybe a couple of videos on that. Please look at this. This is extremely important. The annual returns, how these annual returns stack up, they will determine what happens to your final returns. And this is another problem. Locking up money is good, otherwise it will get spent. Lock-in is good. NPS lock-in is good. PPF lock-in is good. PPF doesn't have much of a lock-in, but okay, relatively. ELSS lock-in is good. I've heard all sort of nonsense. This is not liquidity. What are the aspects of an investment that you should take care of? 4 of them: risk, return, liquidity, taxation, and expenses. These are the 4 pillars of an investment. They have to be favorable. All of them have to be favorable. Otherwise, don't invest your money. In certain cases, yes, a lock-in is inevitable, unavoidable, mandatory. Then you work around and make sure you have enough money elsewhere so you make up for it. That's okay. But these are the 4 pillars of investing. You have to consider all of them, at least be aware of them, and take action, corrective action elsewhere if you cannot avoid the lock-in. Otherwise, it's a problem. Assuming investing in stocks is better than mutual fund. This is another common beginner mistake. See, it is possible for a direct stock investor to beat a mutual fund manager. It is definitely possible, but do not confuse possibility and probability. Possibility is 0 and 1. It's binary. Possible or not possible, that's all. Probability is 0 to 1. Anything between 0 to 1 is probable. You do not know the probability. You cannot judge the different possible direct investors' performance and compare it with fund managers. That's not possible. So you cannot talk about probability. All you can do is you say it's possible. Yes, it's possible to beat. But when you start investing in direct equity, will you beat fund managers? Nobody can say. And this is another problem. I want to know why the fund manager has increased allocation to cash. Why have they bought this stock? Why have they sold this stock? You can sit and talk about it for hours and hours and hours. You will never understand it unless and until you are invited to their fund management meeting table, and you will never be invited. Even if you are invited to their meetings, they will never tell you the real reason. Do not try to backseat drive your mutual funds. Outsource money management and do something else. Look at it from time to time, but don't backseat drive your mutual funds. Finally, market timing. There are two incorrect assumptions. Market timing is not possible. That is the incorrect assumption. This is a problem that has been this is a mis-selling by the financial services industry because they are worried their commissions will be lost and their profits will be affected. Market timing, and the other mistake is that market timing extreme. People who time the markets, they say that they want to time the market to get more returns. Both of them are wrong. Market timing is definitely possible, and market timing has got very high probability of lowering investment risk and just about coin toss probability, 50% this way or that way, coin toss probability of enhancing returns. It has got more than 50% probability of lowering risk, and it has got just about borderline probability of enhancing returns. Sometimes risk will more often than not be lower, but along with that, sometimes returns will be higher, sometimes returns will be lower. And another common mistake is related to the alpha SIP thing. People who say I have got alpha, higher alpha does not mean higher returns. Don't confuse that. Higher alpha means for a particular level of risk, the return is justifiable, and that's what alpha essentially means. I have a separate video on this. Do not confuse alpha and higher returns. That's another mistake. As I'm just thought about that. So I can keep going. There are other mistakes. Please share in the comments. I also please enter your questions for on portfolio management for this week's Q&A. I'll try to do it either tomorrow or on Monday. And if you have any problems with this video, go ahead and comment on that as well. So thank you as always for watching. I'll catch you later. Bye bye.